Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, shall we start? So in the lecture this week, we mainly talked about information problems briefly with the short sale constraint and the behavioral bias. And in the behavioral bias, we mainly talk about this prospect theory, which implies a disposition effect. People trade not according to the utility in the expected utility sense, but they trade according to whether it's gains or losses in the trade. So one application we mainly talk about is how this disposition effect will affect things like whether you participate in the market and how much actually you allocate your risky assets in your wealth. So today I want to provide some examples that you can use the behavioral bias theory to sort of explain the anomalies in the asset pricing, or in other words, how the asset prices will be affected by the behavioral bias. Right, so as we talked about, one thing that's sort of hard to explain with the risk-based theory is about momentum. Right? Momentum is one of those anomalies we observe on the market, but sort of really hard to explain with risk-based theories. But with the behavioral bias theory, we can potentially provide some explanation for that. All these theories, we need at least some proportion of the market to be have bounded rationality, right? So they sort of are rational in some sense, but they are not totally rational in the sense that they may not be sort of looking at the full information set, or they subject to some behavioral bias such as disposition effect. As we talked about, in order to sort of not have the smart investor to arbitrage away all these anomalies, we need some kind of limit to arbitrage. Right, so first set of the model that can explain potentially momentum is the information diffusion theory. Right, so information diffusion theory says that the information sort of takes a while to penetrate to the market. So basically, you can sort of divide the market into two parts. One part is sort of informed investors. They are fully aware of all the informations. And you can call them, for example, news watchers. And the other part are the ones that are sort of based on their decision, based on the observed price movement. Right. So with that, any shock on news will have underreaction in the short run for the stock price. So only a part of the market immediately adjusts their updated price estimates, and the other part of the market actually so they wait for the price signal to appear and then trade accordingly. So this sort of provide the explanation for this short-run momentum and long-run reversal phenomenon in the market. So that's the sort of information-based. But more importantly, as we mainly talk about the disposition effect, right? So how would sort of those behavior effect affect the asset prices? So for example, we often witness price drift in the market, right? So if we talked about, for example, market reactions, right, to some sort of positive news, for example, very big earnings. So if you believe the market is efficient, this price should jump up immediately to reflect all the increase in the earnings and jump up fully. Right, but what we often observe is that the price sort of jump up, but still it has a drift, meaning they're either slowly going up in response to the good news or going down slowly in response to the bad news. So in a way you can sort of interpret this kind of as momentum as well. If you look at the long run, as we talked about many weeks before, in the long run you observe this return reversals, right? So in the long run, the sort of winners eventually becomes the loser, loser eventually becomes the winner. So how can we explain this? One way is to have this model of imprecise overconfidence in the private signal and self-attribution. Self-attribution is a behavior bias, right? And this overconfidence is also a behavior bias. So for example, what do I mean by overconfidence? So if some investors can observe a signal, let's say this S1, which is a combination of the true price, theta, and some noise, epsilon, right? So the overconfidence says the variance of individuals' confidence, individual perceived distribution of this signal is sigma c squared. And this is actually smaller than the true distribution, the true noise of sigma epsilon squared. Right, so if that's the case, we'll see how actually price respond to that. And what do I mean by self-attribution? So let's say not only you have this private signal, you can also have subsequent public signal. So self-attribution is that if the public signal confirms what the private signal is, which means if the public signal have the same sign as the private signal, then the investors becomes more confident in their own signal, right? Which means if the sign of this public signal S2 equal to the sign of private signal theta plus epsilon, then you will update your confidence to be more precise. So this variance of sigma c squared will decrease. All right, so it's you probably also observe this a lot in students, right? If they did something well, they'll say, "Oh, you know, I'm really good." If they did something really bad, I don't understand what this lecture is talking about. Right? So it's the fault of your teacher if you do bad. It's your ability if you do well. Right? I mean, I'm not exaggerating. I see this very often. For the investors, it's the same, right? If they turn up to be right, they'll be more confident. If they turn up to be wrong, they don't really decrease their confidence a lot. Right? So what's the implication? So as we remember 2 weeks ago, we said, the price can be written as sort of the conditional expectation given the signal, right? So here the signal is theta plus epsilon, and the price is true undervalued price is theta. So you're trying to infer theta given the signal is a combined signal with theta and epsilon, right? So if you remember, the price will be rho, which is the information precision, which is the variance of signal divided by the total variance. Right, so remember that's 2 weeks ago, right? We talked about this rho in the signals. And this signal, this coefficient, which is informativeness, times theta plus epsilon. And because this individual has behavioral bias, so this sigma c square is actually smaller than sigma epsilon square, which means the price that's end up in the market will be higher than what the true signal implies, right? So this causes this overreaction to your private signals. Right. And without further behavior bias, if you have a public signal, then price will underreact to public signal because the price will be a weighted sum of your private signal and your public signal, right? And because you put more weight on your private signal, so the reaction to your public signal will be an underreaction without any sort of further behavior biases. So immediately you get this result of this overconfidence will result in negative long-run autocorrelations. Okay? But to generate the momentum, we also need this self-attribution bias. Self-attribution bias, as we said, is that your confidence increase when the public signal will confirm your private signal, but not much if your public signal do not confirm your private signal, right? So if that's the case, then, for example, when you have a positive shock, so the price increase, right? And because of your overconfidence, price overreact, price increase more than it should be. And if the public signal confirmed that, then your confidence will increase. And because of your confidence increase, the price will further actually increase, right? Because you sort of increase in the confidence of your positive signal. So in the short run, it generates this positive lag operations, which we can call it momentum. And because eventually the price will go back to its fundamental level, so eventually you also have long-run reversal. Right, so this model actually explains both the short-run momentum and the long-run return reversals. Right, so to put it into a perspective, so if you start with time zero, right, the rational expectation theory, given a positive shock of the news to the price, is that it should jump up, right, and then stay the same. That's the rational expectation theory. Now, with overconfidence of your own signal, this will overreact, right? So this will overreact to a higher level, and if there's no further distortion, it will gradually goes down to the fundamental level. But if further you have confirmation bias, right? Now, if you have a positive signal with a confirmation bias, your overreaction will stay to be high because you further increase your confidence for the next period. So this will increase further. And so this from time 0 to time 2, that's the momentum effect. And when it essentially goes down, that's the return reversal effect. Right? So with overconfidence, we observe the overreaction. With the self-attribution, we observe momentum and the return reversal. That's one of the models, right? Now let's see the disposition effect. Because we talk a lot about this disposition effect, which means, what does that mean? That means if you have a gain, right, then you're more likely to sell your stock. If you have a loss, then you are less likely to sell your stock, right? So that means investors are more likely to hold a stock for which good news causes an increase in the valuation. Right. So that means if you face a positive shock to the stock price, so the stock price increase, but when the stock price increase, investor faces gain. Right? Now they want to actually sell it. Okay? So the supply, stock supply, or the selling of the stock will increase with the price gain. So this part of the price gain will be offset by the increased selling. Right? So that the increase in price will not be up to what it's supposed to be initially. Right. So this process will actually lead to price to increase in the value facing a positive shock gradually, which will generate what we observe in the momentum effect. But if you think about this, this not only implies momentum as we usually says, right? So when we usually talk about momentum is cross-sectional momentum. You buy the winners, you sell the losers. This implies not only you can have momentum, but also you have momentum in time series. Right? So this is sometimes also called time series momentum. So to put things into a little bit more sort of framework, if you are a rational investor, right, your demand will depend on this F minus P. So F will be the fundamental value of the stock. P is the price, right? So if the fundamental value is more than the price, you'll have more of the demand for the stock. However, if you are biased, which means, or if you have the disposition effect, your demand not only depends on F minus P, it also depends on R minus P. And R is the reference point that investors use. Right, so the reference point usually take to be the point investors actually buy those stock, or the price investors sort of observe prior to the PT. right? So that means if this if a stock is trading at a loss, right, then the demand will actually be higher. Right, so there's increased demand by the disposition effect investors for stocks that trading at capital loss. And if there's a capital gain, the demand will be lower. Right, so capital gain meaning price will be higher than your reference price, reference price. So if price is higher than that reference price, so this will be negative, right? So the demand will be lower than your initial demand. Right. So if you look at paper by Greenblatt and Han, they sort of precisely show this momentum is correlated with what's called the capital gain overhang. Basically, it measures how much the investors actually have the nominal capital gains without actually selling it. Right, so they use some combination of the turnover to sort of measure that. A related point is that because the investors are actually, how much they actually traded before matters. So that makes the volume actually be relevant when you have the behavior bias. All right, so imagine, for example, if, say, 2 people traded 3 days ago, right, they traded at price equal to 1. 10 people traded 2 days ago, traded at a price of 3. Now, 2 people have, now the current price is, let's say, 5, right? So the nominal gain for the first 2 people will be 4, right? The nominal gain for the second 3 people will be only 2, right? So the price nominal gain of these 4 people will be more like, sorry, what did I say? 2 people? 2 people. Anyway, the first one who bought, right, will have a higher nominal gain, and they are more likely to sell. So how many people actually bought the stock and the volume of the trading now is relevant for the actual supply in the market. Right? So now you can have a model that actually trading volume matters. Because up to now, when we talk about the rational models, we don't have any role for the volumes. Right? We only talk about the prices and the returns. Right, so what's the evidence we can have? As I said, one evidence we can look into is the time series momentum, TSMOM. Right, so time series momentum just says the past H period return, here normalized by their standard deviation, their volatility, can actually predict the future 1 period return for each of the assets. Right, here, it's normalized by the standard deviation because if you want to sort of form a portfolio, you want to sort of have the portfolio momentum be adjusted by their volatility, right? Or in other sort of interpretation is that the sign, whether it's positive or negative, of your past return will be relevant in predicting the future return. Right? Some of you will say, oh, what's the difference between this and this regression? We run this regression of return on the lag returns, right? So here, mainly it's using the lag multiple period return to predict the future one period return. Right? Before that, we used lag one period return to predict future one period return. Now we're using lag of the multiple period return to predict the future one period return. So the information is a multiple periods because the people's disposition effect will depend not just on the one period, it depends on the whole history of your trading, right? So the multiple period return is important in terms of the time series moment. You can download this paper and download all the data from AQR Tradings. You guys know AQR Tradings? AQR Trading is quantitatively based hedge fund, and they have a lot of PhDs working on that. Right, so I think one of their principal, together with two guys from Chicago, they wrote this paper about in 2011. Right, they wrote this paper about time series momentums, and they posted all the data and posted the article on their website, so you can check that out. We'll just do a sort of mini version, right? So what I want to do is just to get the data, daily data of S&P 500 from Yahoo. Right, so this is the daily data, and I just calculate return using the adjusted close. Now, in order to be sort of normalized by the volatility, I need something that sort of estimates the volatility with the time-varying volatilities. If maybe you heard of GACH, right? Is the generalized autoregression in the error terms, heterogeneity. So what I'm just following their paper to use exponentially weighted estimate for the volatility, which is equivalent to a simple GACH model. Yeah. Yeah, so if you look at this graph, so this is basically the volatilities, right? So this volatility, like increase in the financial crisis, increase during the dot-com bubble, increase with the 87 crash. So this volatility changes so they match up with what we think about. Right. But for our simple just one variable estimation, this isn't really sort of absolutely necessary because we're not forming the portfolios. Right. So this weighted by volatility thing is only important if you want to form the portfolios of multiple assets. Right. Okay. Now, what I did is to convert, so resample, right? Convert everything into the monthly returns. So resample with the months and using the cumulative return formula to convert. And I only take the last value in the cumulative returns, right? Because I'm converting the daily data to the monthly data. And I just drop the missing value and put them into data frame. And then I calculate the rolling 10 months, so rolling 10 months return with the cumulative return formula, right? Because it's 1 plus r times 1 plus r, etc., minus 1. And then with this lag cum, the lag cum return, I can determine the sign of the lag return. It's either positive 1 or negative 1, depending on whether it's positive or negative. Okay? And then I also get the future 1 period or 1 month return. So this is shift minus 1. That's the shifting it forward. So it's a future return. Right? Now I get the time series momentum is basically this 0.4. It doesn't really matter. It's just a parameter because I want to match the volatility. And then the sign of the lag return, lag 10 months return, times the future 1 month return divided by the annualized significance. So in a sense, you can see that this is calculating the future returns using this sign as the weight. Right, so if this sign is positive, along this return. If the sign is negative, I short this return. Right? So with that, you can see it actually earns really high abnormal returns. Right? But some of you say, oh, you know, is this sort of this isn't totally risk-free, right? How do you sort of compare? So we can also run this time series regression. Right, so this regression is basically a regression of this one. Right, so I'm regressing the returns on the multiple months, sign of the multiple months. And I'm plotting the t statistic with all those regressions for different lags. Right? So you can see that initially lag 1, 2, 3, 4, well, they are not significant, and sometimes it's negative. So from lag 5, suddenly it's become significantly positive, and it remains to be quite high with the t statistic. Not everything is significant, but it remains to be sort of quite significant from lag 5 months to lag 12 months, which means if I use the sign of lag 5 months or lag 12 months cumulative returns to predict the future return, I get quite significant result. Right? And this is just for one S&P 500 from 1963. If you do it with indexes from different countries, indexes from different contracts, such as futures, such as commodities, you all observe this phenomenon. Then what you can do is to sort of form the portfolio of this time series momentum, and with the diversified across the different assets and only taking advantage of the time series predictability. Okay. There's a negative evidence, right? So this is also evidence, but evidence in a negative way. So when we say the disposition effect, we need some kind of the reference price, right? So we need for the investor to be able to sort of refer their gains and the losses from some past price observations, right? a recent paper, I think it's published in 2015, finds that if you look at the stock splits, so what do the stock splits do? So if you are a stock trading at a 10, right, and it splits 1-to-2 ratios, now the price suddenly becomes 5, right? And if price suddenly becomes 5, but because stock is still trading, right, so it could be like 4.8, it could be 5.2, depending on whether the market moves. So suddenly, because of this, sometimes investors got confused. What is really should be my reference price? Right? If you are sort of really rational, well, you know the reference price should be 5, right? But because of this splits, a lot of investors actually got confused of this reference price where the starting point. So if you look at the stock splits, around the stock splits, the disposition effect breaks down. Right? You no longer observe that people sort of sell more when there's a price gain, and people sell less when there's a price less. So this is sort of the evidence that this, at least a part of those momentum, part of this anomaly is in fact caused by the disposition effect or the price reference problem. Once it's not easy to sort of, once your price reference is confusing, then you don't observe this disposition effect as clearly. And I think that's all I want to talk about. And we don't have any new material for next week. Everybody's like, oh. Right. I decided that we have enough of the materials. We talk quite a lot in this class, right? So we covered the major bases in terms of rational asset pricing, absolute asset pricing, relative asset pricing, and then we talk just a little bit about when you have information asymmetry, when you have sales constraint, short sale constraint, and when you have behavior bias. And this behavior bias thing is a very active research, right? As we talked about, one can never be sure whether market is indeed efficient or whether this efficient hypothesis is because of the joint hypothesis problem or indeed you have behavioral explanations. But people are sort of trying to pile on the evidence about the behavior explanations, partly because, as we will see here, once you open the door to the behaviors, then a lot of phenomena on the market is a lot easier to explain, right? If you want to sort of just stick with the risk-based explanations, then sometimes you have those puzzly things that's not easy to explain that happen on the market. But once you open the door of the behavior, then there's a lot of things sort of can be reinterpreted of, you know, why the price theory is that way and why the return theory is that way. Okay. What's the difficult part? That's not difficult. Well, don't you have some sample code on the lecture notes? Yeah, another week will be too long because you need to give the tutor time to grade that also, right? And some will also complain, they don't have time for go over the material. They are still spending time to do the assignment. Let me see. I can shorten the question. You can, for example, I don't know. I can throw out the last question.
We need the last question.
You need the last question? Really?
Yes. Please not. Don't skip it. Don't skip the last question.
Just give us
What?
today.
Why?
The last question is simple.
Oh, last question is simple. Oh, really? I thought the last question is hard. The other question is simple. Yeah, but it doesn't mean you did it right, especially if you got huge momentums. If you got huge momentums, I don't think you did it right. Yeah, actually, I don't know what it is. Well, next Friday, that's not possible. I can.
On Monday, Tuesday, Wednesday.
I can do. Sorry? Yeah, that's also true.
Yeah, maybe.
Yeah, because 2 weeks is not a very short time, right? I already give you 2 weeks. Yeah, I think I will just stick to Friday or Friday 6 p.m. That'll be good?
No.
Yeah, 1 hour. That's good. Because, you bargain, you get something, right? So it's happy for everyone. Yeah, so, yeah, I'll get it to be 6 p.m. tomorrow. Yeah. I mean, by the way, it's not, if you find it really difficult, maybe you should go back to look at the lecture notes and everything there. I think I'm pretty sure most of the structure is already there. Right? It's just different data and everything. Yeah. Any other questions? I'll talk to tutor. I don't think, you need. You mean the next Wednesday thing, right?
Yep.
Yeah. Probably not. You want the tutorial? Okay. So last time he already gave you sort of the list of the topics, right? Okay. And in what aspect do you want him to talk about?
Past exam questions.
He doesn't know.
We want to know.
Yeah, so my plan is do a little bit of review next Monday. Is a Monday class, right? Yeah, so next Monday I'll do some reviews and possibly give some examples. Although I'm not too sure it will stay exactly the same format. Because I want the exam to be sort of more flexible. Instead of, you have to. Flexible meaning not really testing your sort of math skills, but testing your sort of understanding, maybe with a little bit of math skill. Right? Yeah, so my plan is to do the review and hopefully talk about some examples of different forms of questions that could be asked. And yeah, if you wanted the tutor to talk about, he can talk about, but I don't think he actually knows. I mean, even I don't know what's going to be on the exam. Yeah, so you guys want the tutorial? Yeah?
Maybe just go through some most important part.
Most important part, I already told him yesterday.
All the parts. It seems like
You told him all the parts.
Yeah.
So, I mean, if there are some specific parts that sort of more emphasized. You're giving him one list and that's everything.
Well, I think you can kind of guess, right?
Yes.
Yeah. I think you're taking the classes long enough to actually know what's important. Right, so for example, when I actually ask you to derive this Campbell-Schiller decomposition by yourself, I won't. Right, with all the log linearization, then take the sort of, I won't. So what I actually, for example, sort of ask you sort of how the, for example, relative risk aversion are derived? Probably not. But what I ask you, what is really, how do you actually really use the relative risk aversion? I definitely will. Right? I mean, I could, for example, give you a utility function you've never seen. Right? And then you can calculate like risk aversions. And maybe the risk aversion can even change. Because all we talk about is like constant relative risk aversions, constant absolute risk aversions, right? Maybe the risk aversion can change when the consumption changes, and this certainly has implications for your investment as well, right? Because your asset allocation partly depends on your risk aversion, right? So I can write the whole question, starting with some utility function and ask you a bunch of things. I mean, that's sort of my thinking, right? So, yeah, so when I'm saying you can kind of guess, what I mean is you can sort of guess my mind, right? I haven't made the exam yet, so when I try to make the exam, what would I be thinking? Right. Yeah, so Monday we'll do the review, and if you want, Wednesday we can do. I can ask the tutor. So next Thursday, we don't have workshop. Right. So next Thursday, I can change the workshop to consultation. So same time, right? So instead of doing the workshop, I can do the consultation. I know. But not just next week, right? Then normally we'll schedule like 2 hours or something before the finals week.
Just 2 hours? That's too short. Yeah, you're so popular.
No, because I don't see you guys often. Yeah. Yeah, so I will see. Currently, I think the current plan is I'll have at least 2 hours, and the tutor will have at least 2 hours.
Can you extend your consultation?
Yeah, so I mean, if there's sort of, you know, a queue of students, maybe I'll sort of look at my schedule and see. But my current plan, I don't want to, you know, just be waiting and, you know, oh, where's my student?